Long-term investing? Well, long-term investing is where you invest for over a period of 1 year. This is due to the utilization of compound interest and leaving your money for a long term opposed to day trading in the short term. Well, let's explain compound interest. Compound interest is the generation of money being added together over a period of time. So, for example, if you say had $500, right, and you wanted to invest, right, you do that at 10%, over the end of the year, you'd have $50. Now, what would happen if you did the same amount, $500, but instead of a 1 year period, you did a 5 year period, but it was $100 each time? Well, at the first year, you'd have 110, so it'd go to 210, and then it'd be 331, and then 464, and then $611 over the 5 years. You still had the same initial investment as you did over here of $500, right? But in the same interest of 10%. But it's what happens when you reinvest or you leave your money in, it grows and grows and grows. So your nearest shore deposit zero, your regular deposits $500, 100 each year, and the total interest is $111. That's $61 more than just putting it as a giant lump sum of money. So this is where the whole theory of invest early and hold it in for the long term. That's why people tell you to save or invest while you're young, because you can maximize this compound interest to grow. Well, why is another reason that you'd invest long term or over a year? Well, it's because that on your money you get tax, capital gains tax. This is from investments such as real estate, when you sell real estate, when you sell stocks, when you sell crypto. This is a taxable event. So what happens on the short term with capital gains tax is that, say you're single, up to $9,950, you get taxed 10%. And this ranges all the way. So if you have over $526,601, you're paying 37%. Well, on long-term capital gains, you get 0% up to $40,400 if you're single. So right here, you would have been paying 22%, but instead you're only paying zero. That's incredible that you're taking a 10%, 12%, 22% cut. So that means you're making 22% more, technically just holding it in for longer than a year. So by waiting over a year of time, you're saving money that you would have paid in capital gains tax. Another reason that you'd want to invest long term is because of the volatility in the markets. Well, this is the SPY, or the S&P 500 ETF. If you watched my last video, you'd understand what this is. This is just to view it. And as you can see here, that over the long period of time, it's got a general uptrend. Well, if you go 5 years, it has more things, like it massively dropped here. You go to 1 year, and as you can see here, is massive ups and downs and ups and downs and ups and downs. Even just the 5 days. Here, massive ups and downs. So what happens when you invest long term is you avoid all this. You avoid all this is because you're not watching the highs. You're not trying to buy in at the lows. You're not trying to guess the market. You just put your money in and it just grows. As you can see here, you put your money in and it just grows over time. That's what happens when you long term invest. Well, let me explain the negatives of loss of recovery. So, for example, if you say did this, like you were a trader or you cared about your portfolio and you're trying to buy the lows, you're trying to sell the highs, and you're trying to watch everything like this, right? Well, let me put this thing. If you lost 5%, your end balance of $1,000 would be now worth $950. Well, in order to get that same $1,000 that you started off with, you'd need to gain a 5.3% return to gain the $1,000. Well, you go, alright, there's only 0.3%, but it scales. Say you lost 10%, right? Then it's like $900. Well, you need to earn 11.1%. It's not earn that 10% back. It's earn 11.1% just to earn the $1,000. One of the big things here is if you say you lost 50%, so you put it in $1,000 and you're trying to buy the highs, the lows, everything like this, and you lost 50%. You now have $500. Well, in order to get that 1,000, you'd have, instead of trying to get 50%, you all think, oh, 50%, if I just get 50%, I'd get there. No, you'd only have $750. You need actually 100% in order to get $1,000. This is just groundbreaking in order to understand what happens when you try to time the market. And instead, you should just put your money in and then wait for it to grow. So I put here, what happens is, if you're young and you're trying to invest over 1 year and you're trying to earn 100%, so say you had $100 and you put all this time and effort, like all your spare hours into this, and you get 100% return. That's really good. You turn that $100 into $200. But it might have taken you more than if you just had to spent 1 week working at $20 an hour. So you got $0 and now you have 500. That's a 500% gain, right? Or not 500% because you started with zero, but like you get what I mean. So in order to understand that when it comes to investing, you have to put all your variables into play. You have to work out your time and your money. It's really good to make 100%, don't get me wrong, but you could utilize your time way better with opportunity costs in my first video, that it might be better just to work at minimum wage or work at, say, $20 an hour. I just did that because it was a easy number to do, but you're getting 500 here. When you're making 100%, you might have put the same amount of hours in. Might have put the same, say, 25 hours in. Well, another thing that we have to talk about is, besides what time is valuable for, is that dollar cost averaging. So that's where you put your money in at a certain period of time every single time. It's also known as like recurring payments or dollar cost averaging, where say you put it on, say, the first of every month. This is just a photo that I got that highlights some of the days. This isn't to date or specific advice, and this video is not financial advice. But say you put it in on the first Monday of every month, right? Or you put every single Monday, or you put every single Sunday. You just choose a time to just keep putting your money in. It's also known as dollar cost averaging, where you decide to put, say, $100. So from earlier that you earned the $500 a week, say you use $400 and you save that $100. Well, on, say, the Monday or every week, you put that $100 in to an investment, and you can decide if you want to put it in, say, the SPY. Better graph. I just say this one because it's the most drastic effect and it's the easiest way to explain. But you put it in at $100 a week, or you put more than that, less than that, it's totally fine, and you just keep doing that, and you just set and forget. You don't have to worry about it. You don't have to worry about the ups and the downs. You don't have to stress, and you're making money. But if you did want to put a bit more time in, they have a bit free time that you couldn't spend working, that you do want to do, you should look at competitive advantage. Well, what competitive advantage is looking at businesses, companies that do something superior compared to something else. This might be the Access. This is from the Corporate Finance Institute. But an example is to access to natural resources that are restricted from competitors, highly skilled labor, unique geographic location, access to new proprietary technology, so just new technology, ability to manufacture products at a lowest cost, or brand image recognition. But all these things is what you can look at if you don't want to do, say, that an ETF, which is just a group of it that you want to try and choose one stock. Or one investment, one crypto, one something, that you do your research beforehand. And it's just understanding what makes this better than anything else. And I can take a look at what the benefits is, the target market, the competitors, the strategies. Cost leadership is trying to get the cost at its bare minimum. So that could be like the business is outsourcing or going for cheap labor, or it just makes it really cheap, so therefore they have the ability to lower the price and beat competitors. Differentiation is making something different, and also like the main focus which is cost focus, differentiation focus. It's basically just one of the two, but that's what makes a business unique or different. And this resource is really good because it explains the three different businesses McDonald's, which its main competitive advantage relies on cost leadership, which is why they have such like the low cost menu, the low dollar menu, the $1 menu, or whatever it is, that is enticing people because it's so cheap, because it costs very little to create the products. Louis Vuitton, advantages on differentiation and a focus on the luxury market. So it's targeting luxury people, therefore it has a competitive advantage because it's generating more money because it's targeting higher people and higher wealth people are buying their product. And again, Walmart, same as McDonald's, cost leadership, everyday low prices. And this website goes more into, I explained most of it, but that's what you have to look at when you're looking at different companies. But the main takeaway from this video is that you should invest long term opposed to short term, that you should, this isn't financial advice, but this is what I do, and I that's what I do, so then you can take that as what you will. But you put your money in a certain amount from your paycheck, or a certain amount that you can afford to lose, because all investing is risky and you can afford to lose, and you put that in and you just keep doing that every week. You can do it every day, every month, whatever period that you want, and long term you will see growth. Thank you.